So this is not kind of like a crystal ball moment where you can see, hold on, look at that unemployment rate is rising, breaking out, but the rate of change of the unemployment rate is rocketing upwards, guys.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Okay, everybody, welcome to another episode of Talking Trades with me, Kevin Wadsworth, and my friend and business partner there, Patrick Karim. Pat, what are gold and silver miners saying about the economy at the moment? Because they've moved up a lot just recently. And also, perhaps you could let us know when is gold a better hold than the miners?
That's right. Those are great questions. Everything's going crazy in the miners are going great. Everything's doing at gold. But, our job is to show like the objective evidence and also show them, what are the miners telling us? Like they're going up in price, but what does that tell us about the economy, right? And people, you could also relate that. They could call that the business cycle. I know there's different terms, but it has nothing to do with the stock market. It has some links with the stock markets. I'll show you some charts about that, but it's about, the markets rolling over, the unemployment rate starting to go upwards, stuff like that. So what I'll do is I'll just share my screen. All right, guys, I'll start with this chart. This chart is the gold and silver miners. That's the black line, guys, since 1972, all right? Since 1972. And I have the unemployment rate, the initial claims, the U.S. initial jobless claims overlaid on it. So you got to take a step back there. When I show you this, you got to take a step back, look at the overall trends. So yes, they're not, from a returns correlation, it's not very high or the highest it could be, but from a trends, right? Higher lows on the gold and silver miners, higher highs on the gold and silver miners, the initial jobless claims, right? Higher lows, higher highs in the 70s. That's what it was, guys. So the miners, they sense that U.S. economic turmoil, that business cycle rolling over, having a hard time grabbing a good footing. And they love that. In the 80s, the greatest bull era for the stock market, well, guess what? The initial claims were doing lower lows, lower highs. Get what the miners were doing. Lower lows, lower highs, same thing. And the 2000s, again, guys, same thing as like the 70s, higher lows for both of these, up. And look where we are today, guys. The miners are doing higher lows. Now they're doing higher highs, but the U.S. initial jobless claims have not broken out yet. So this chart is from September 11th. And it is possible they revise these numbers and then we'll have a huge jump like, whoa, that jump wasn't there on the chart. But because they're able to revise that, I suspect that the miners are telling us that there will be a revision upwards. And if it's not a revision of these numbers we see here, it will be the new numbers coming in will be skyrocketing. We'll have a crazy up move. And that's what the miners are sensing. And I'll show you another chart. Here is a similar analysis, but using unemployment rate. So at the bottom pane, I have the rate of change for the unemployment rate. And look at that. The miners, again, that same miner chart I showed you above, as unemployment rate goes up, the rate of change of it, even the actual unemployment rate, the miners love going up. And as the unemployment rate unwinds, the miners, it's headwinds for them. Look at the 2000s. Look at that. The rate of change of that unemployment rate kept going up and up. And guess what the miners did? Up and up and up. And again, this is a little precursor to what might happen to the U.S. Initial jobless claims, guys. The rate of change for the unemployment rate is rocketing upwards. And guess what the miners are doing? Rocketing upwards. Even here during 2020 there, you had the rate of change exploding for the unemployment rate. And look what the miners did, exploded. So this is not kind of like a crystal ball moment where you can see, hold on, look at that. Unemployment rate is rising, breaking out, but the rate of change of the unemployment rate is rocketing upwards, guys. And the miners are just pricing that in. They're just, they're anticipating this economic turmoil, right? The destruction of purchasing power that's going to be required to save the business cycle, to save the economy. The miners just love that. Here I have the non-farm payrolls. Another way to see it, another economic metric. So the non-farm payrolls, there's this red line here. When we cross below, and I have those recessions overlaid here, often when we cross below that red line, there's some type of economic event, a turmoil, recession, bam, priced in. This is the link to the stock market. Is you'll often see a market drawdown during these periods, right? People are losing their jobs, not as many people in the workforce, maybe the automatic, 401k pensions now taken from those salaries, it's not being injected in the stock market. Whether it's shallow, like in the early 1990s, or like a 2001 crisis or 2008 crisis, or the multiple ones we had in the 70s, the setup is there for an SPX drop. The setup is there for a recession. And if you combine that with the miners that are breaking out, sensing the unemployment rate going up, those jobless claims and all that stuff going up, then you have a huge setup for that. And of course, here I have the yields. I have the 10 minus the 2, the 10s and the 2s overlaid on the same price scale, guys, on percentage. And again, I have the recessions overlaid. And look, when the 10s and the 2s start trending downwards, but the 2s accelerating faster, that's when you have market turmoil, economic turmoil. That's when the miners, they do better, especially in the 2000s and the post-2008. Gold did great, all that whole region. Here again, in 2020, that huge move down for both of those. And look where we are today. The 10s minus the 2s, they're both turning down. And if that gap widens, and if we get some rate cuts, and the 2s is going down, actually is the market telling the Fed they should be cutting right now. It's the Fed that's behind the curve. The market knows best. The Fed is not leading the market. The market's telling the Fed, you should be dropping your rates, especially via the 2s. And they're starting to turn down. So again, the low risk entries for the stock market is when the 2s are so low and they're starting to catch up back to the 10s. That's the good time to be in the stock market, right? Most of the time. Or when they're both compressed together, those are great times for the stock market. But if ever those jaws start expanding downwards with the 2s crashing because they're cutting rates because of unemployment rate, skyrocketing, it's not a good recipe, guys. It's a setup. People, they don't want to see these setups there. When the market's going up, they have a hard time understanding these setups happening in the background. But we're looking at it. Don't front run it. You look at it. And Kevin, finally, to answer your question about gold, when will time to be long gold again? Well, here's the gold and silver miners priced in gold. So over very long periods of time, that's since the late 1960s, gold and silver miners are just terrible priced in gold, right? Lower lows, lower highs. It's not a good look for the gold and silver miners. But there are phases where they are trending upwards. And that's here, it's that line here. Gold and silver miners have been trending upwards against gold for the past many months, right? So that's a period right here until we hit that next resistance zone there that you should be favoring gold and silver miners instead of gold, right? Doesn't mean they can go down. Gold and silver, the miners can go down. But it just means that the gold and silver miners right now will go down less than gold as long as this line keeps going up until it hits that resistance. And I'll just show you something that people aren't looking at. The bottom pane, I have the unemployment rate. And check it out. The gold and silver miners' performance versus gold. So the gold and silver miners priced in gold usually top out. So it doesn't mean nominally they topped out, but their performance versus gold tops out when the unemployment rate peaks and starts unwinding after a capital rotation event. So here you have in the 70s, the gold and silver miners did great early on, but after that, they just did equal to gold and worse as time moved on. The 2000s, same thing. Gold and silver miners did great at the beginning, but after that, as soon as unemployment rate peaked, guess what they did? They performed equal to gold, but then worse than gold. And then they just gave up all those gains. And so right now where we are, we're not quite there yet. I don't think unemployment rate has peaked yet. And the gold and silver miner chart, Kevin, is still going upwards on their own price chart versus gold. So there's still some room for those miners to run. But as soon as the market starts turning down violently, that could be when the train halts there.
Yeah, of course, the miners are loving it at the moment because their bottom line has improved because the price of gold has doubled and energy costs have stayed low. When that equation changes, and the miners won't be quite so happy anymore, and precious metals, gold, silver, will will probably be outperforming. And of course, the miners are much more volatile, and there may be individual miners that continue to outperform, of course, right the way through the bull market. But we're talking about the aggregate of the mining indices here. But gold and silver, of course, are gold is king. Silver has its turn to outperform, and then the miners underneath that are more risky and volatile. And me personally, I would have a smaller allocation to the miners, but of course that's entirely up to you. So brilliant stuff there, Pat. Thanks for all of that. And if you enjoyed that and you want more, don't forget to like, subscribe, and hit the notification bell there, and we'll bring you more. Bye bye for now.